Okay, so in this video, I'm going to be explaining my understanding for the Fin 223 final assignment. So question one was about portfolio optimization. So the first step was downloading all the prices and then converting those prices to returns. After that, I got the average weekly returns for the 20 stocks and then the weekly variance and then annual return and annual variance by multiplying it with 52. After this, so I have the returns for all the stocks, the annual returns, and I transposed it. And then I got the variance covariance matrix. And again, I had to multiply it with 52, right? Because there are 52 weeks in a year. After this, using the returns, the annual returns and the variance covariance for each of the stocks, I was able to calculate the expected return and the standard deviation, assuming that it's an equally weighted portfolio. And then I used Excel solver to optimize the weights with the main aim of minimizing standard deviation, which is the risk. And then I also added one more objective, which is to ensure that the minimum weight for each of the stocks is at least 1%. And then expected return should be equal to 15.14%. Right? It should be the same. And then after this, I calculated the portfolio CAPM. So I had to first calculate the beta for each of the stocks, which is basically the slope of the stock. So it's the stock returns, comma, the market. So in this case, the market return is MSCI World Index. Okay, and based on, then I had to multiply the individual beta with the weight, and I got and then the sum of the beta times the weight for each of the stocks gave me the portfolio beta. So my portfolio beta is like minus 0.03. So it's close to zero. What it means is that um, it means that compared to the market, my portfolio is very unresponsive. So if the market's going up, there'll be no correlation with my portfolio. So based on the portfolio beta and the risk-free rate and the average and the yearly market returns, which is for MSCI World Index, I got a CAPM of 3.80%, which means that I should expect a return of 3.80% based on the market and the risk-free rate. And then after that, I got the efficient frontier. So I got the efficient frontier curve and the CML line. So how did I do the efficient frontier? So basically, I used the Excel solver and I kept changing the returns. So I made the returns 2%, and then based on the output of the Excel solver, I uh, got my risk and the Sharpe ratio, right? And then accordingly, based on these results, I was able to get it on this graph. And then similarly for the CML line is the capital market line. And it's basically the risk-free rate plus the optimum Sharpe ratio times the risk. So I did that for 0 to, assuming it's 0% risk, 2% risk, 4% risk, so on till 44% risk. And the whole point is the line where the CML and the efficient frontier curve meet is it's the optimum risk return to risk. It gives the highest Sharpe ratio. But my return and risk is, for the portfolio, it's 15.14 and 13.41. Why? Because in the Excel solver, I had kept the objective as to reduce standard deviation, which was to minimize risk. But if you want the optimum, if you want the maximum, if your objective is to maximize the Sharpe ratio, then my return would be 22% and my risk, no, sorry, my risk would be 22% and my return would be 29.75%. The optimum Sharpe ratio is 1.17, which means for 1 unit of risk, my portfolio would give 1.17 units of reward. But again, the weight would change. It would be on a different set of weights. Okay, now I'm going to be explaining my understanding for question two. So for question two, it was the IPO analysis, right? And I basically first I found out all these dates and then I calculated the share price. It's in dollars. So 1 day after the IPO, 5 days after the IPO, 1 month, and then 2 months after the IPO. And overall, what I found was, so I then did the technical analysis for ALEC. Then this is do and Gulf navigation. So overall, what I found was the share prices were very steady and it was low volatility, which means there wasn't much movement, right? So for example, this is do. So you can see from April till do had its IPO in 2006, but you can see in April 2023 or 2022 till July 2024, the price hasn't done much. It's just gone sideways. It's in consolidation. But then after April 2024, there was an upward trend. So the share price for Do went up from 1.50 to 2.63. So what I've understood is from the IPOs of from the Dubai markets is that usually in the beginning it's very slow, but then it also in the if you hold it over a long period of time, the long term, you can expect to see returns. Okay, and again for Alec had its IPO in 2025. The share price hasn't done much. Like it just went from 0.38 to 0.36 and then back to 0.39. Overall, it's just steady, low volatility price move. And again, with Gulf Navigation, they didn't have the IPO in 2025. They had a share issuance to convert bonds into equity, right? And again, you can look at the even regardless of the IPO, the share price it's very like sideways. It's mainly in consolidation. And so my overall recommendation for investors looking to invest in IPOs in the UAE is that um, IPOs in the UAE, they offer potential for stable long-term returns, but they typically lack the rapid initial upside seen in IPOs in countries like the US or Europe. But obviously, if an investor wants to hold it over a long period of time, they can expect to see some returns. But it's not like high growth or short-term speculative gains. You won't see that at least in my opinion, in IPOs in the UAE. And then yeah, question three was about analyzing the January effects, Monday effects, and momentum contrarian strategy. So what I found was with January effects is that the returns for January is high. That's what January effects assumes. So I took my index was the S&P 500. Time frame was 5 years. So this is monthly data. And what I found was the average January return was actually lower compared to the other months. So January's average return was 0.59%, whereas for the other months it was 1.09%. And overall, I found that January effects was not evident in the S&P 500. You can also look at the p-value, which is 0.7751, and it's nowhere near the zero point zero 0.05 threshold, so it's not even significant. And then Monday effect. So Monday effect is that returns will be lower on Monday. So what um, what investors would want to do if they assume that the Monday effect is real is that they'll sell their stock at the end of the week, which is Friday, and then they'll buy it back on cheaply on Monday. Okay, so Monday effects. So my average, again, it's S&P 500 and it's daily data for 5 years. What I found was the average Monday return was actually higher. So I got 0.07% return, and the average for the other days was 0.05%. Again, you can look at the p-value for the t-test to 0.776. It's not statistically significant. Monday effects does not hold. January effects doesn't hold. And then finally, the momentum and contrarian strategy. So momentum and contrarian. So momentum is basically when uh when a stock momentum is when you buy a stock. Let's say you look at the top five winners and the top five losers. So you buy the winners with the expectation that the price will keep going up, and you sell the losers with the expectation that the price will keep going down. But contrarian is when you expect that the price will reverse. So winners will come down and then losers will come back up. Okay, and based on these results, so it's a mix, right? Some days contrarian strategy would have worked, and then other days momentum strategy would have worked. Overall, I find there's no, yeah, so this was a 12-day test, and overall, some days exhibited momentum and then others showed contrarian behavior. Average contrarian profit was 1.97%, and average momentum profit was 1.50%. Overall, neither strategy worked consistently for S&P 500. Also, I forgot to mention was, so for example, 20th November, right? I got the returns on 20th November, and then the next day returns, which was 21st November, right? So if the figure is, so I took the average of the returns for the winner. So basically 21st November's average return, and then same for the losers. And what I found was if the number is negative, then it means that contrarian strategy would have worked. But if the number is positive, that means momentum strategy would have worked. Yep, that's it.